In this video, we're going to look at budgeting. Budgeting is the process of predicting or estimating financial consequences of future events. Budget reports are accounting reports prepared based on future or predicted events using estimates and predicted data. This is me making a prediction of how a cake I'm making will look like when it's done. Actual reports are accounting reports that are prepared based on historical events that have occurred, using actual and verifiable data. Actual reports may not necessarily be the same as budgeted reports. A little like how my cake turned out. A variance report is the difference between the predicted data, that is the budget, and actual data. What's the purpose of a budget? It is to assist planning as well as to aid decision-making. How so? Budgets can assist planning by helping the business prepare for what is likely to occur. For example, the business is planning to purchase a car in July. The business can prepare by organizing a loan or capital contribution to fund the purchase. On the other hand, budgets can also aid decision-making by helping the business identify unsatisfactory performance and decide on remedial actions. For example, actual sales are consistently lower than budgeted sales. That are the sales targets. Decisions can therefore be made to improve sales performance. In this next section, we'll be looking at preparing budgets, with the first one being the budgeted cash flow statement. As we can see here, the format of the budgeted cash flow statement is the same as the actual report. The only difference here is in the title of the report, where we have specified that this is a budgeted cash flow statement for a period. Before we prepare the budgeted cash flow statement, we'll need to be able to determine the budgeted cash flows. To do this, we can firstly use the information provided to us, either the dollar amounts provided, or perhaps we might need to use the percentages to calculate dollar amounts. Number two, we could also create a schedule of receipts from the accounts receivable or schedule of payments to the accounts payable. Lastly, we could also perform an account reconstruction. Here are examples on how we can use the information provided to determine the budgeted cash flows. Example number one, we're expecting a payment for advertising totaling to $600 plus GST. The advertising of $600 and GST paid of $60 are reported as cash outflows in the budgeted cash flow statement. The second example here says that we're expecting payment for wages totaling to 20% of budgeted sales, $100,000. Therefore, we need to report wages of $20,000 as a cash outflow in the budgeted cash flow statement. To determine cash flows relating to receipts from accounts receivable or payments to accounts payable, we need to create a schedule. Here's an example. We are told that we receive 60% of credit sales in the month of sale, and 40% of the credit sales is received in a month after the sale. In this example here, we'll need to create a schedule of receipts from accounts receivable. Let's try to create one together. Here, the owner wishes to prepare a budgeted cash flow statement for July and August. The owner provided the following sales data. We are told that the actual sales in June was $10,000, and the budgeted sales for July is $11,000 and August $12,000. The above sales amounts do not include GST. Also, 80% of the sales are on cash. Lastly, we are told that the receipts from the accounts receivable are expected as follows. 60% of the credit sales are collected in the month of sale, and 40% of the credit sales are collected in the month after the sale. This is how a schedule of receipts from accounts receivable looks like. First, we list the months with the corresponding sales amounts that we are told. In this case here, in the month of June, we had sales of $10,000. For July, the budgeted sales was $11,000, and for August, the budgeted sales was $12,000. Because the sales are split into cash and credit sales, we therefore need to create another column here to calculate the credit sales. In this example, we are told that 20% of total sales are on credit. So in June, 20% of $10,000 is $2,000 credit sales. For July, the credit sales would be $2,200, and in August, the credit sales would be $2,400. The sales amounts we have calculated exclude GST. Therefore, we need to calculate the GST. For the month of June, the GST on credit sales was $200. In July, $220, and in August, $240. Next, we need to calculate the credit sales including GST. The reason we need to do this is because the total amount including GST is owed by the accounts receivable. So for June, the total amount owed by the accounts receivable would be $2,200, which includes the GST. In July, the accounts receivable will owe $2,420, and in August, $2,640. The last step is to calculate receipts from accounts receivable based on the percentages we were told. Note, however, we are only calculating the receipts for July and August, and this is because these are the months that we are preparing the budgets for. Let us start by looking at the credit sales in June. Because July comes after June, we know that 40% of the credit sales made in June will be received in July, which is the month after sale. Therefore, to calculate the receipts from accounts receivable in July, we take the credit sales including GST of $2,200 multiplied by 40% to give us an amount of $880, which is the receipt from accounts receivable. By the end of July, the total credit sales made in June would have been fully repaid. Therefore, we do not expect any more receipts from accounts receivable in August for the June sales. Moving on to the credit sales in July, we can see that the total credit sales including GST is expected to be $2,420. We are expecting 60% of this amount to be received in the month of sale, which is July itself. Therefore, we take $2,420 multiplied by 60% to give us $1,452 of receipts from accounts receivable in July. And in August, which is the month after sale, 40% of the credit sales in July, which is $2,420, is expected to be received, and the amount calculated is $968. Lastly, let us have a look at the credit sales in August. Logically, nothing will be received in July. However, in August itself, we are expecting 60% of the credit sales, including GST, to be received in August. So we apply 60% to the total credit sales, including GST, of $2,640, and this will give us receipts from accounts receivable in August totaling to $1,584. From our schedule, we can see that we're expecting receipts from accounts receivable in July to be a total of $2,332, whereas in August, we're expecting receipts from accounts receivable to be $2,552. Here we can see how the expected receipts from the accounts receivable in July and August are reported in the budgeted cash flow statement for July and August. Now that we know how to prepare a schedule of receipts from accounts receivable, the same approach can be used when preparing a schedule of payments to accounts payable. Here's a final word of caution when preparing the schedule of receipts from accounts receivable. Whenever there's a split between cash and credit sales, we mustn't forget to include the cash sales and the corresponding GST received in the cash flow statement. Based on the information we were given, we are told that 80% of the sales are expected to be on cash. Based on the budgeted sales for July of $11,000, we therefore expect 80%, which is $8,800, to be cash sales, and the GST on the cash sale is $880. We report these amounts in the budgeted cash flow statement for July. We do the same thing for August. You may also be required to do account reconstructions to determine cash flows. For example, you may need to reconstruct the accounts receivable, accounts payable, and inventory ledger accounts to find the receipts from accounts receivable and payments to accounts payable. Let's have a look at this example in detail. As we can see here, we've been given the opening balance of the accounts receivable account, which is the actual balance of $60,000 on the 30th of June. The budgeted closing balance on the 30th of September is $58,000. We're also given the estimated transactions for the quarter ending 30th of September. And here we can see that these transactions all affect the accounts receivable. The instruction is for us to reconstruct the accounts receivable account to calculate the expected receipts from the accounts receivable in the quarter ending 30th of September. First, we start by putting in the opening and closing balances. As we can see here, we've been given the balance on the 30th of June, which is effectively the opening balance on the 1st of July. And that's $60,000. The next step is for us to draw the total lines here so that I can see where I need to put my closing balance on the 30th of September, which is on the credit side, just above the total lines. And using our balancing technique, we know that on the 1st of October, our opening balance will be on the debit side, $58,000. The next thing that we need to do is to record the estimated transactions for the quarter ending 30th of September. Let's start with the credit sales of $180,000 plus GST. This transaction will lead to an increase in the accounts receivable since it's a credit sale. And the increase is by $198,000 because the total amount including GST is owed by the accounts receivable. Because this is an increase to the accounts receivable, we debit the accounts receivable account for the amount $198,000. And the cross-reference would be sales and GST clearing. And since this is the estimated sales for the quarter ending 30th of September, we simply put the date 30th of September here. We are told that the estimated sales returns would be 2% of credit sales. So we take 2% multiplied by the estimated credit sales of $180,000. And this gives us $3,006. But this amount excludes GST. So we need to add the GST, and that will give us $3,960 including GST. A sales returns will lead to a decrease in accounts receivable, therefore the accounts receivable account will be credited. And it will be credited for the full amount, $3,960 including GST. So on the credit side of the accounts receivable ledger account, we write $3,960 with the cross-reference sales returns and GST clearing. And this is for the quarter ending 30th of September. For the quarter ending 30th of September, we're also estimating a discount expense of $800. As a discount expense will lead to a decrease in accounts receivable, therefore this amount will be recorded as a credit to the accounts receivable account. So on the credit side of the ledger account here, we record $800 with the cross-reference discount expense. And since the date 30th of September has already been written here at the top, we do not need to write it again. For our last transaction here, we're estimating bad debts written off to be $1,100. When this transaction is recorded, we recognize a decrease in the accounts receivable. Therefore, we will credit the accounts receivable account. So here on the credit side of the ledger account, we record $1,100. And bad debts are written off against the allowance for doubtful debts. And because we also have a GST adjustment, we need to record it here in the cross-reference. In this final step of the accounts reconstruction, we're going to find the missing figure, which will reveal to us the expected receipts from the accounts receivable. Before we calculate the missing figure, let us consider where this missing figure might sit. Would it be on the debit side or the credit side of the accounts receivable ledger account? The missing figure relates to the very thing we are asked to determine, and that's the expected receipts from the accounts receivable. When this entry is recorded, it would lead to a decrease in the accounts receivable. Therefore, it will be recorded on the credit side. For this, we put a circle on the credit side of the ledger account to let us know that this is where the missing figure sits. It will have a cross-reference bank, since this is a receipt from the accounts receivable. To calculate the missing figure, we firstly start by adding up the current amounts on the debit and credit sides of the ledger account. So starting with the debit side, 60,000 plus 198,000, that gives us 258,000. And on the credit side, the total is currently $63,860. Since 258,000 is the larger amount, we put this amount in the total lines. The last step to determine the missing figure, we take 258,000 less $63,860 to give us the missing figure right here on the credit side of $194,140, and this represents the total expected receipts from the accounts receivable for the quarter ending 30th of September. The estimated receipts from accounts receivable totaling to $194,140 will be reported in the budgeted cash flow statement for the quarter ending 30th of September under operating activities. We will now be reconstructing the inventory and accounts payable ledger accounts to determine the expected payments to the accounts payable for the quarter ending 30th of September. Here are the steps that we will follow to help us reconstruct the accounts. Firstly, we're going to record the opening and closing balances. And secondly, we're going to record the transactions given. I find it useful to create general journals on the side as workings to help us determine how to correctly record the transactions in the general ledger. Then we're going to record other transactions that are not listed. And since no amounts are given, we're going to draw circles where there are missing figures. And lastly, we're going to work out the missing figures by starting with the ledger account with only one missing figure. We're now going to start with the first two steps. Now we're going to start with step 1, and that's to record the opening and closing balances for both the inventory and accounts payable ledger accounts. Once we've done that, in step 2, we're going to record the estimated transactions for the quarter ending 30th of September, starting with cost of sales, $105,000. And this is a decrease to the inventory account and therefore recorded on the credit side of the inventory account. An inventory loss also leads to a decrease in inventory, therefore recorded on the credit side of the inventory account. Thirdly, we have purchase return, which reduces inventory and therefore recorded on the credit side for the amount $1,200. A purchase return also decreases accounts payable, and this is recorded on the debit side of the accounts payable ledger account. However, what we note here is that the accounts payable is reducing by the total amount of $1,320, which includes a GST of $120. Then we have discount revenue, which is a discount that is received from the accounts payable. Because discount revenue reduces the accounts payable balance, this is recorded on the debit side of the accounts payable ledger account. Lastly, we are told that all purchases are made on credit. On this basis, we know that there won't be any cash purchase of inventory. Now we're on step 3. Since we know that all purchases are made on credit, we would expect a purchase of inventory on credit in the quarter ending 30th of September. So for this transaction, which is a purchase of inventory on credit, we would have a debit to the inventory account with a cross-reference Accounts Payable. And a credit purchase would also increase the accounts payable, therefore it would be recorded on the credit side with the cross-reference inventory and GST clearing. Lastly, we're also told that we are calculating the expected payments to accounts payable. And this is a transaction that we know will happen in the quarter ending 30th of September. And a payment to accounts payable will reduce the accounts payable balance, and therefore it will be recorded on the debit side. And since it's a payment, we will have to cross-reference as bank. The last step, step 4. Now we're going to find the missing figures, starting with the ledger account that has only one missing figure, and that's the inventory ledger account here. To calculate the missing figure, we're going to start adding up the amount on the debit and credit sides as it is at the moment. So here on the debit side, we have a total of $44,000, whereas on the credit side, we currently have a total of $152,360. Next, we write the larger amounts in the total lines. And to find the missing figure here on the debit side, we take $152,360 less $44,000, and that would give us the missing figure of $108,360. We also know that this relates to the credit entry here in the accounts payable ledger account, because this is a purchase of inventory on credit. However, the amount that should be credited to the accounts payable account should include GST. This is because from a credit purchase of inventory, the total amount of the purchase, including GST, is owing to the accounts payable. So we take the inventory cost of $108,360, add 10% GST, that would give us a total of $119,196 that is owing to the accounts payable. As you can see here, we have worked our way down to our last final missing figure, and that's in the accounts payable ledger account. So we're going to finish up this process by firstly adding up the current amounts on the debit and on the credit sides of the accounts payable ledger account. So here on the debit side, we will have a total of $27,110, and on the credit side, we would have a total of $143,196, and that's including the missing figure that we have worked out earlier. So because the amount on the credit side is bigger, we're going to use that amount and write it in the total lines. In our last and final step, we will calculate the missing figure here. And to do this, we take the $143,196 less $27,110, and that will give us the missing figure of $116,086. And this represents the expected payments to the accounts payable for the quarter ending 30th of September. In the budgeted cash flow statement for the quarter ending 30th of September, we report a payment to the accounts payable totaling to $116,086 as a cash outflow. Here's a suggestion on how you can practice the account reconstruction skill.